Welcome to the latest episode of the Financial Frontier. I'm your host, Patrick Camuso, and I'm looking forward to today's episode. There are a lot of topics on the regulatory front that I want to get to, a lot of tax news in the headlines, a lot of things that we need to be considering now to prepare for in the future. So, like I said, there's a lot to get into. I'm not even sure I'm going to be able to hit on all the topics today that I want to discuss. So I want to get right into things. Um, Before we get started, there are a few things I want to bring to your attention. I'm going to just open up my screen here for video viewers. I also do a video live broadcast of this and share my screen so we can get things to be more interactive. So, first thing that I wanted to bring to your attention is on December 7th, 2023, we're hosting a webinar. There are close to 200 attendees going to this right now. It's called Web3 Tax and Accounting Essentials. Here I'm going to go over everything that you need to know as a Web3 founder or CEO, a Web3 CFO, CPA, accountant. Everything that you need to know if you're looking to manage a Web3 company from a tax and accounting perspective, from setting up an accounting system to managing your tax structure, strategies, and processes to make sure that you both protect your bottom line and that you can make business decisions and document your tax positions with your accounting methods. So this will be really valuable. December 7th, be sure to sign up. You can sign up over at LinkedIn. If you go to my website at camusocpa.com, this is where you can sign up for the Digital Asset Digest, which is our newsletter. I cover a ton of relevant topics, tons of topics similar to what I cover on these lives, but they'll either go into more detail or we'll go over topics that I wasn't able to get to on these lives. So be sure to go to my website under the resources section under newsletter. You can sign up for that. And then lastly, if you go over under resources at camusocpa.com to our blog section, our latest blog that I wrote is called The Future of Tax Regulations for Cryptocurrencies and for Web3 Predictions and Insights. So I go over some of my predictions here and some of the current issues that I'm seeing. So this article, again, it's another very relevant topic for anyone that is a CEO, founder in Web3, digital asset investor, tax professional, CFO, CPA. This is sort of relevant all around for everyone. So definitely be sure to check that out. So let's get into some of the topics. First off, as you see here on investing.com, Bitcoin transaction fees hit 6-month high, outpacing Ethereum. So, we're starting to see some sentiment shift here in the market, and some of that is actually showing up in the data on chain, which I love to see. So I just thought that was positive and a little aside that I wanted to mention here. Now this article is from Accounting Today, and it's titled Crypto Traders Go Mainstream. So basically, most of this article is blocked off here, but basically what this article says is that the usual person that you would think of as a crypto investor is usually a younger person, tech forward, college educated, a lot of disposable income. That's why they were buying altcoins 5 years ago. There's been some recent studies where they went and they polled people that are involved in crypto. And basically what this article says here is there's little separating crypto investors from holders of any other assets. So basically what this article is stating, what this study is showing, is that it's not just one small group of people that is buying crypto anymore. It's everybody from all different types of walks of life, just like there would be for any other asset class. So it's us moving towards a new phase of maturity, adoption, and as this article says, it's crypto really going mainstream. So I think this is positive. I love seeing a headline in an article like this from Accounting Today. This article is by Chris Catano, who is great over at Accounting Today. I've been in many articles of his quoted, so definitely go check him out. So let's get into some of these real nitty gritty topics here. So IRSAC asked IRS to address tax filing, crypto payments, and EINs. So there was an IRS Advisory Council report that was released just recently this year. The report's linked in this article, and we're not going to go through the report because obviously it is very lengthy. But what was interesting is one of the things in the report was that it provides guidance on the potential use of cryptocurrency for federal tax payments. So you heard that right. The IRS may start accepting cryptocurrency as a form of payment for taxes per the IRS Advisory Council report that was just released here in 2023. So I think this would be interesting because especially a lot of crypto native people are, holding a lot of crypto assets and sometimes do have to liquidate them to pay their tax liability. So there is a convenience factor here. That's what they were alluding to in the report. And it's nothing that's happening yet, but it may be something that happens in the future. So I thought that was very interesting. If the IRS does decide to accept crypto, that'll be a pretty cool headline, I think. So then this report here, this is another lengthy report, and no one's really covered this yet, so there hasn't been too many headlines on it. This is from the New York State Bar Association. Basically, this is their response to the proposed regulations for information reporting on digital assets that they put out during the comment period. As I've covered, there's been thousands of these comments that have went out. Obviously, I don't have the time to read them all. What I've been doing is seeing the ones that are published and basically, seeing who wrote them and trying to read the ones that I think are going to have the most details, newer perspectives, or, just some of the ones that I hope are going to be better. This was one that when I saw it, I knew I had to read it, and it certainly didn't disappoint because there was some interesting suggestions in here. All of them I can't really even go over. This was one of the more detailed ones that I've seen in terms of people's responses. Now, one thing in here that I wanted to hit on that I thought was interesting that I actually took a snapshot of is that one of the suggestions here is for the IRS to actually start to create a identity or privacy token, basically like a non-fungible token that'll be used for identity purposes. Some people may refer to it as a soul-bound token, and to use that to start as a substitute for IRS tax forms, and to start collecting taxpayer information on chain when they're making transactions across decentralized exchanges. So here it says Treasury should permit the creation of identity privacy tokens that can store taxpayer identifying information, including substitute IRS forms W9 and W8, and be used across the platform by QDARPs to reconcile and report information. So they basically what they're suggesting is to create a way to identify taxpayers on chain, hold their identity on chain. So then when you go and you're transacting, the information related to your transactions is going to be associated with your unique identity token. And then the information related to those transactions can be used for reporting purposes. It can be sent back to a centralized authority. So that's what they're suggesting. I thought this was interesting because this was one of the first places that I've personally seen this addressed. So comment below, what do you think about that, having a identity token or a soul-bound token that's on chain, basically tracking your personal data and tracking your transactions for tax reporting purposes. It will make tax reporting more seamless in certain ways, potentially, but also, as you see right now, industry-wide with the proposed broker regulations, the level of collection of taxpayer information is a concern from a privacy perspective. So I'd like to hear what thoughts are from people on this industry wide, because I haven't seen this really talked about much. Then again, it's only a suggestion, but I think this is where things are moving towards here in the future. Um, so this goes on. I don't want to go into it all, but it goes on here to start talking about how this information will be sent to a qualified digital asset reporting person, what they refer to it as. So in order to achieve this goal, we propose creating the concept of a QDARP, which we envision as a service provider to the digital assets marketplace that will gather and verify information about their transactions in the marketplace. It will link up their wallet addresses to real world identifying information, receive, aggregate, and reconcile information from all the various digital asset middlemen, and it goes on. So basically, the reason they're suggesting this is right now, under the proposed broker regulations, it's making most decentralized protocols that are acting as middlemen, it's turning them into brokers. It's creating tax reporting requirements for them. Many of these protocols are decentralized enough to where there's no one that's even going to really tax report. In some cases there are, but they're probably just going to geogate US taxpayers. So this is their suggestion, is to sort of take the actual burden of reporting off of these decentralized protocols, but use an identity system that ties back those transactions on the person that's making the transaction, sends it back to what they're calling a qualified digital asset reporting person that will compile all this information for tax reporting purposes. So this is interesting. As you can see here, it goes on. I don't want to get into too many details with this because there is a lot more that I want to cover, but I think this is a really, really interesting topic. One thing here that they mentioned, though, is an identity token that embeds an IRS form can also be programmed to expire automatically and require a new token to be minted at regular intervals for someone to continue transacting. So if something like this does get set up, there could be a scenario in the future where if someone isn't compliant, they can even be stopped from transacting on chain. Let's see here. So this goes on. Like I said, there's tons of details in this. I would encourage you to check this out. It's about 34 pages. It's definitely worth the read. So this next article is at Forbes, 2 more reasons why tax compliance is increasingly difficult. So I thought this was a good article. It first goes to hit on the fact that the reporting requirements are constantly changing, and that pace of change, I believe, is just going to accelerate over the next months and years, just because the regulatory part of this is just in such great focus right now. Then this article goes on and it lists the second issue being trading income will be harder to track. And one of the things that it goes into talking about is the proposed Section 645 changes that, these are basically, he's saying, like everyone else is saying, it's going to increase reporting requirements and make things a little more complicated for taxpayers because the complexity is going up. One thing that was pointed out here that I haven't seen pointed out in many other places, and this is something that I have been stressing at Camuso CPA during this phase of the new regulations, because this is sort of confirming this, but even before this phase, and that is that people that are using specific identification are going to have huge problems in the future in terms of the accuracy of their accounting and how that's going to reconcile with future tax reporting that they get on their cryptocurrencies. So you'll see here, basically, specific identification is looking nearly impossible. I would say it's always been nearly impossible. And the reporting that people have been doing by just, cherry picking advantageous accounting methods after the fact, which don't fit their actual facts and circumstances of the movements of their assets on chain, need to go to FIFO. But many people are using specific identification because it is an option in most tax softwares. You can choose HIFO rather than FIFO usually, and you're going to get a better tax result. But the question is this acceptable for tax purposes? And is it also practical from an accounting perspective once we consider how we're going to have to reconcile this against the tax reporting that we're going to get? So this explains it well. To implement such an approach, referring to specific identification, the specific asset would need to be identified before the trade occurs and not after the fact. So that's been the issue. We have the crypto Q&As. I think it's 39 and 40 really touch on accounting methodology. Basically, it says you need to use FIFO unless you meet certain criteria, and then specific identification is acceptable. And it lists really basic information that you have to provide. But what people are doing is they're providing this information, but that's not in fact what really happened on chain. They'll maybe transact with Ethereum across several wallets and several exchanges and have assets spread out across all of these different addresses. And then when tax time comes, they may be sold an asset via Coinbase, but they're going to apply the cost basis from an asset that's on Binance because it's more advantageous from an accounting perspective that they maybe under HIFO that they chose. This is after the fact, though. This isn't at the transaction level. And this is what they're saying here, is that this isn't going to be acceptable when we're trying to meet the requirements for specific identification. And then once we get into these broker reporting requirements and exchanges are reporting your basis and your information, they're going to reconcile things on FIFO. They're not going to have any of this information either. So, it goes on to say this would seem like a simple process, but central exchanges like Coinbase are not equipped to provide such tracking, even more complicating. So this is going to get into the reconciliation. If investors have to use alternative tracking methodologies in the past and have also a FIFO-based return from the exchange, the manual reconciliation process will occupy a large amount of their time. So I think it's questionable that taxpayers in the past who are using specific identification meet the requirements because the documentation that they're giving doesn't actually reflect their on-chain activity. And now this problem is going to be coming to a head further as exchanges start to report to people on a FIFO basis. So here he goes on to say, stated another way, reporting requirements that are being solidified are going to create either larger tax liabilities or very much larger workloads than originally thought. So ultimately, what's shaping up is that the way that you're going to have to select your accounting methodology is basically the way that we've been selecting it for our clients all along, in that you have to use FIFO unless you meet the actual requirements in fact for specific identification, which usually is like they're saying here, is going to be administratively burdensome to a taxpayer because you need to be segregating the tax lots that you purchase as you're purchasing them in different wallets and then moving them strategically to sell them based off of their tax lots if you want to use specific identification. If you do this, it does add a lot of time and effort to your reconciliation process, and now you're going to have the added issue of exchanges reporting to you likely on FIFO. So this accounting method is going to be a huge issue for taxpayers going forward. And there's a ton of taxpayers that just relied on the software or relied on a firm that just blanket chose one accounting method that gave them the lowest tax position possible. But this really is a great example of, we want to optimize your portfolio and your business for taxes, but that's always secondary to protecting your assets. And by protecting your assets, we need to make sure that we're taking the right positions on your return and we're thinking about your current year as well as future years. So, people that went for this more aggressive accounting method in the past can potentially have issues here in the future. Let's see here. Okay. So another thing I wanted to hit on here is you're going to be hearing, and you probably are already hearing, a lot about Kraken in the news, and that is due to the John Doe audits. Kraken is just going to be something that a lot of taxpayers regret in the coming years, and that's just because of the level of underreporting and the level of data that the IRS just received from Kraken, and that's what this article here goes over. There were some interesting facts in this article. One was, let's see here. The IRS testified that in 2013 to 2015, only 800 to 900 taxpayers filed returns with anything that said Bitcoin or virtual currency. At that time, Coinbase had 5.9 million customers and handled more than 6 billion transactions. And then tax returns rose from 4,164 in 2016. That's when we started reporting at Camuso CPA, to 842,000 in 2021. Still not even a million then though. So the level of people that haven't reported is just huge. And now not only do they have the Coinbase records, they have the records from Kraken. That gives them all the transactions on Kraken. Right there, they're going to be able to get tons of people that haven't reported. They're also going to be able to see where they're withdrawing, where they're depositing from. That starts allowing them to map a lot of the non-custodial wallets and ownership associated with them. So, what were they granted? Account user registration records, user profile, user preferences, application information, name, date, birth, taxpayer ID, history of all changes to personal information, complete user history for protocol addresses used to access the account, complete user payment methods, all records of activity in the user's accounts. So they have all these records. I'm expecting a ton of future tax enforcement from this, The best thing to do is, if you're a taxpayer who has transactions on Kraken and you've underreported, contact a CPA, contact me and my team at Camuso CPA as soon as possible and start to get this reported, because you want to be proactive. You want to get out ahead of these compliance issues. It's much better to report now on your own accord, under your own calculations, than waiting to get a tax notice from the IRS, likely having to reconcile and respond to that notice. So a couple more things that I wanted to hit on here. This is another thing that I've been talking a lot about. I've been one of the only tax professionals that I've seen covering this topic, assisting clients with this topic, creating solutions for this topic. And that is how state taxation applies to crypto assets, specifically how sales taxes is going to apply to crypto assets. Now, here at taxnotes.com, this is a transcript of a podcast from Wally Hellerston of the University of Georgia's Law School, who is actually discussing this same topic. So I encourage you to check out this podcast. Obviously, I'm not going to go through it all, but one thing which they hit on a lot here is that sales taxes, use taxes, and VAT taxes are something that is likely going to apply to many types of transactions in dealing with cryptocurrency, whether you're selling crypto for a taxable product where sales taxes generally applies, or whether you're selling something on chain like an NFT that's going to be looked at as a digital product and good, and sales taxes may apply there depending on the state. So this is something that um, tax professionals are starting to wake up to, the fact that sales taxes, NFTs, and just sales taxes on chain in general is going to be a huge issue going forward. It's something right now going widely overlooked. I published probably 50, 100 videos on this just this year on sales taxes, because I think it's such a big issue that I've been trying to warn about. I've posted videos with state by state guidance on it, and I have a whole website dedicated to this topic. We're building technology solutions to help our clients and prospective clients actually be able to facilitate collecting and remitting these sales taxes on chain. So this is something that I'm very focused on, and I believe is going to be a huge, huge, huge issue going forward. So definitely check this out. And then on the same token, we see here in local Florida news, Florida is proposing a sales tax holiday for what? For cryptocurrency. So yes, sales taxes apply to cryptocurrencies. They apply to transactions on chain. So Florida is actually proposing a sales tax holiday. This is interesting because this is sort of like a small thing that can actually help with crypto adoption, because basically they are introducing legislation that would implement a sales tax holiday for purchases made with Bitcoin and other virtual currencies. So if you're in Florida and maybe you're going to buy a book, and usually that book will have a sales tax associated with it, under the sales tax holiday, if you purchase it during the holiday, you purchased it with Bitcoin or another crypto asset, you wouldn't have to pay the sales tax. So you would effectively get a discount. So it says, with this bill, we would modernize our tax holidays and ensure all Floridians can benefit from a great holiday passed by our legislator. So it would provide an exemption from June 1st to July 31st in the year 2025. So basically 2 months. According to the report on cryptocurrencies, nearly 75% of U.S. retailers intend on accepting it at various locations by the end of 24. So I thought this was interesting. We'll see if Florida passes this sales tax holiday. Again, this is something that me and my team are watching very closely. All things related to sales taxes, NFTs, and cryptocurrency. We're watching, we're consulting the people on, and we're building solutions for. So be sure to look into this more. And if you are selling NFTs, or if you're selling products or goods on chain and you're concerned with your sales tax compliance, or you're looking for solutions to accurately collect this on chain in a seamless manner for your customers, contact me today and I'd be happy to discuss that with you further. So lastly, I want to get into a client case study that I posted a few weeks ago on LinkedIn. And about once a week now, I'm trying to post a write-up on, a client that I've either recently worked on, or one that, I worked on in the past and I just thought of, that has a unique fact pattern that I think other people are experiencing and can benefit from and can learn from. And this one here is about an NFT artist. And the long and short of this, and really what I wanted to hit on here, because this goes into like a few different things that we did with him, but the big one is that we cleaned up his accounting system, we fixed tons of issues with that, we got him moving forward with a correct accounting system so he can make estimated tax payments, make good decisions from a business perspective. But one of the most important things that we did for this NFT artist, because this was during the last bull run, was explaining to him to manage his assets appropriately and to take his tax liabilities from what he was getting from NFT sales. A portion of that he was going to have to pay taxes out of, and to basically estimate what his taxes are, move it out of Ethereum, into USD and to make estimated tax payments. It sounds very simple. This effectively cut this NFT artist tax bill by half because we told them this during the last bull run. Then tax season came, and then Ethereum fell in price. If you would have kept those tax payments held in Ethereum, and Ethereum drops by say 50%, he would have effectively doubled his tax payment. So just by us giving this one simple piece of advice, which is do not expose your tax payments to validity risk, we were able to really save this NFT artist bottom line. Now, how does this relate to you? Because if you're an investor taking profits on chain into maybe Ethereum or into another asset, if you're a Web3 business or an NFT artist and you're selling on chain and you're getting paid on chain, and you are going to have to pay your tax liabilities out of these on chain revenues, you need to manage your treasury appropriately. You need to be estimating your taxes, and you need to remove from the validity risk your tax payments by moving them into stables or moving them into USD. It's something that sounds simple and seems simple, especially when you're not in a bull market. Once you're at a peak of a bull market and you're getting paid in say Ethereum, and then it goes up by 20% the next day, not everyone's going to be that inclined to pull some out and put it aside for taxes. But the knife always cuts both ways. There's always going to be another bear market, and the IRS is still going to be looking for their payments on all of the revenue that you generated throughout the year when Ethereum or any other asset was at its peak price. So keep this in mind. You don't want to make this mistake. I've seen this blow up people's portfolios. I've seen this really, really hurt people's businesses from a cash flow standpoint. So keep this in mind and don't give into the bull run euphoria when it comes in this regard. So these were most of the topics that I wanted to cover today. There were a few more that I didn't get to, but I try to keep these around 30 minutes or under. I know this one's a little bit over, but there was a lot to cover here today. So I hope that you took some value from it and you gained some insights from it. If you have any year-end tax planning or accounting needs, or if maybe you've heard me discuss some of these sales tax topics related to on-chain transactions and you need some guidance related to that, contact me and my team today at camusocpa.com. Message me on social media on LinkedIn or Twitter. Me and my team will set up a time for us both to speak directly one-on-one, learn more about your business, learn more about your investment portfolio, and see where we can help you. So thank you again for watching The Financial Frontier. Until next time, I'm Patrick Camuso, signing off.